One expert says buy gold right now. Another says put every spare dollar into stocks. A third one says stay away from stocks because a huge crash is coming. Your uncle says just save cash and never touch the market. So who is actually right? And more importantly, what should you do with your own money in 2026? By the end of this video, you will know exactly what to do, step by step. No confusing terms, no guesswork. Most people who study money for a living agree on one thing. The confusion around investing is not because it is hard. It is because most explanations are way too complicated. This video strips all of that away. We are going to cover why investing matters, how the stock market actually works, and the exact steps to start, even if you have $0 invested right now and zero experience. Stick around, because the last part covers the question almost everyone is afraid to ask. What happens if it all goes wrong? Let's start with part 1. What investing actually is, and why it matters. Investing sounds like a big scary word, but here is the plain truth. Investing just means putting your money to work so it makes more money on its own. That's the whole idea. So why does this matter so much? There are two big reasons. Reason 1, your cash is quietly losing value. This is called inflation. Prices for food, rent, and everyday stuff keep going up a little every year. But the cash sitting in your bank account does not grow on its own. So if you have $1,000 sitting in a savings account today, in a few years that same $1,000 might only be able to buy what $800 buys today. Nothing about your money changed, but the world around it got more expensive. Keeping all your money in cash feels safe, but it is actually a slow, quiet way to lose buying power every single year. Reason 2, owning things beats just earning a paycheck. Think about how wealth gets built in today's economy. People who own things like property, stocks, or a piece of a business tend to grow their money much faster than people who only rely on a paycheck. Picture two neighbors. One bought a small house 20 years ago. Today, that house might be worth double what they paid. Another neighbor put money into the stock market over the same 20 years. On average, that money would have grown by around 8 to 10% a year. Now picture a third neighbor who just worked a normal job that whole time. Their paycheck barely kept up with rising prices. None of these 3 people did anything wrong, but only 2 of them let their money grow while they slept. This is the real reason people invest. Not to get rich overnight, but to stop the slow leak of inflation and start using the same tools that build long-term wealth for everyone else. There is also a mindset shift that matters here. A lot of people treat investing like something only rich people do, or something you need a finance degree to understand. That idea keeps millions of people stuck in a loop of earning, spending, and never quite getting ahead. But investing today is more accessible than it has ever been. You do not need a broker in a suit taking your calls. You do not need tens of thousands of dollars sitting around. Regular people with regular jobs and regular paychecks are the ones who benefit the most from starting early. Because time is the one ingredient that money cannot buy back once it is gone. Think of it this way. A small amount of money invested consistently over many years tends to outperform a much larger amount of money invested for only a few years. That is because of something called compounding, where your returns start generating their own returns. It sounds small at first, almost boring, but stretched out over 10, 20, or 30 years, that boring habit becomes the single biggest factor separating people who build wealth from people who stay stuck. Now that you understand why investing matters, let's talk about how the actual system works. Before we move on, quick heads up. Everything in this video is completely free, and you do not need thousands of dollars to start. Some of the steps coming up in part 3 can be done with as little as a few dollars. So keep watching, because the next part explains exactly what your money is actually buying when you invest. Let's move on to part 2, how the stock market actually works. Here is something most people have heard about their whole life, but never really understood. What actually happens when you buy a stock? When you buy one share of a company, you are literally buying a tiny slice of that company. If you buy one share of a shoe company, you now technically own a small piece of that shoe company. You are saying, I believe this business will keep growing and become more valuable, and I want a piece of that growth. Once a company decides to sell shares to the public, those shares trade on the stock market. Think of the stock market as a massive marketplace where millions of people are buying and selling tiny slices of thousands of different companies all day, every trading day. Prices move up and down based on what people believe those companies are worth right now and in the future. Nobody controls the stock market from one central place. It runs on the collective opinions of millions of buyers and sellers, from huge investment firms to everyday people investing from their phone. When more people want to buy a stock than sell it, the price rises. When more people want to sell than buy, the price falls. News, earnings reports, interest rates, even rumors can shift what people believe a company is worth, which is why prices can swing so much in a single day. There are two main ways this makes you money. Way one, the price goes up. Say you buy a share for $100, and a few years later it is worth $150. You can sell it and keep the $50 profit. That growth in value is called a capital gain. Way two, dividends. Some companies share part of their profits directly with the people who own their stock. This usually happens every few months or once a year. It is basically the company saying, "Thanks for sticking with us. Here is a small cut of what we made." Many long-term investors choose to automatically reinvest those dividend payments back into more shares instead of cashing them out. Over many years, this small habit adds up in a big way, since each reinvested dividend buys a few more shares, which then produce their own future dividends. This snowball effect is one of the quiet reasons long-term investing works so well, even without picking a single flashy winning stock. Now here is the part that trips people up. Should you just buy shares in your favorite big company and call it a day? You could, but here is a real example of why that is risky. There used to be a phone company that basically every office worker on the planet used. If you bought one share of that company back in 2008 for around $140, that same share would be worth only a few dollars today. Back then, almost nobody could imagine a world where that company would fall apart within a few short years. But new competitors showed up, habits changed, and the company that once felt unbeatable became a footnote. That is the risk of betting everything on one company. Even a company that looks completely unstoppable right now. Even people who spend all day reading financial reports and studying balance sheets struggle to predict which companies will still be winning in 10 years. Here is another example worth thinking about. There used to be a video rental chain with thousands of stores in nearly every town. For years, it seemed impossible that anything could replace the simple habit of driving to a store on a Friday night to pick a movie. Then streaming showed up, and within a few short years, that entire business model disappeared almost overnight. The people running that company were not foolish. They simply could not see far enough ahead to prepare for a shift that fast. This happens across nearly every industry eventually. Retailers, tech companies, car manufacturers, even entire currencies rise and fall in ways that are almost impossible to predict years in advance. This is not meant to scare you away from the stock market. It is meant to explain exactly why spreading your money across many companies instead of concentrating it in one or two names protects you from a single bad surprise wiping out your progress. So what do smart long-term investors actually do instead of trying to guess winners? Most of them buy a huge basket of companies all at once through something called an index fund. An index fund is basically a giant bundle that holds shares in hundreds or even thousands of different companies at the same time. A common example is a fund that tracks a major stock market index, which is just a list of the largest companies in a country. That single fund might include tech companies, energy companies, healthcare companies, banks, retailers, all bundled into one investment. Here is why that matters. If you had put a small amount of money into a broad market index fund 30 years ago and left it alone, reinvesting any payouts along the way, your money would have grown many times over, averaging somewhere around 7 to 10% a year, depending on the exact time period and how inflation is factored in. Some companies inside that bundle would have failed completely. Others would have exploded in growth. But because you owned a little bit of everything, the overall basket kept climbing. Now you might be thinking, why not just skip the boring bundle and go all in on today's biggest winners? Right now, there is a small group of massive tech companies that dominate the headlines and the market. It is tempting to think, Why not just put everything into those few names since they are clearly the best? Here's the problem with that thinking. Look back at the biggest companies from 40 or 50 years ago. Back then, the unstoppable names were old industrial giants, big oil companies, and classic retail chains. Many of those companies are barely remembered today, or they shrank into a shadow of what they once were. One massive camera and film company completely dominated its industry for decades. Then digital photography arrived, and its stock price collapsed by more than 90% within a few years. The lesson is simple. Nobody, not even professional fund managers, can consistently predict which companies will stay on top for the next 20 or 30 years. Spreading your money across many companies, many industries, and even many countries is not boring. It is protection. There is also a global piece to this puzzle that beginners often skip. Different countries and regions go through their own growth periods and slowdowns at different times. A region that struggles for a decade can turn around and lead growth in the next. Rather than trying to guess which country or which company will lead the next big wave, many long-term investors choose funds that spread money across multiple regions of the world, not just one country's stock market. This way, no matter which part of the global economy ends up performing best over the next 20 years, at least some portion of your money is already positioned to benefit from it. It also helps to understand what you are not doing when you invest this way. You are not day trading. You are not trying to buy low in the morning and sell high by lunchtime. That approach is closer to gambling than investing, and study after study shows that even professional traders struggle to beat the market consistently using that method. Long-term investing works on a completely different timeline. It is slow, steady, and deliberately boring, which is exactly why it works for regular people who do not have hours every day to watch stock charts. Now that you know what to actually invest in, let's cover exactly how to start doing it. How to actually start investing step by step. This part is where things get practical. Here is the process broken into simple steps. Step 1. Pick an investment platform. This is just the app or website you will use to buy and manage your investments. Wherever you live, look for a platform that is properly regulated, has a solid reputation, and charges low fees. This last point matters more than people realize. A small fee difference might sound tiny, but over 20 or 30 years, high fees can quietly eat away a large chunk of your total returns. To put that into perspective, imagine two people investing the exact same amount every month for 30 years, earning the exact same returns before fees. One pays a small yearly fee of around 0.5%. The other pays a much higher yearly fee of around 2%, which sounds small, but adds up fast. By the end of those 30 years, the person paying lower fees could end up with tens of thousands of dollars more, simply because more of their money stayed invested and kept compounding instead of going toward fees. This is why comparing a few different platforms before committing is worth the extra 10 minutes it takes. Step 2. Choose the right type of account. Before you fund anything, check what account types the platform offers. Some countries offer tax-advantaged accounts specifically built for investing, where your gains are not taxed the same way as a regular account. These go by different names depending on where you live, but the idea is the same everywhere. Also check if your employer offers any kind of retirement matching program. If your workplace matches money you put into a retirement account, that is essentially free money added on top of what you contribute, so it is usually worth exploring before anything else. Skipping a match like that is often described as leaving free money on the table, since it is one of the very few guaranteed boosts available to any investor, no matter their experience level. Step 3. Add money to your account. Once your account is open, you will typically fund it through a bank transfer or a debit card. Start with whatever amount feels comfortable. This does not require a large sum. Many platforms let people start with a very small amount. Step 4. Choose your investments. Remember what we covered in part 2. Broad, diversified funds are generally a safer starting point than picking individual companies on your own, as tempting as it is to build a portfolio full of your favorite brand names. Most beginners get better long-term results starting with a globally diversified fund and adjusting later as they learn more. A simple way to think about this stage is to picture building a house. A globally diversified fund is your foundation. It is not exciting, It does not make for a great story at a party, but it is the part holding everything else up. Once that foundation is solid and you have built the habit of investing consistently, some people choose to add smaller, more focused investments on top, maybe in a specific industry they understand well or believe in. But that should always come after the foundation is in place, never instead of it. Step 5. Automate everything. This step gets skipped by almost everyone, and it is honestly the most important one. Instead of trying to guess the perfect moment to invest, set up an automatic monthly transfer into your investment account. It could be a small amount or a larger one, whatever fits your budget. This approach is called dollar cost averaging. Some months you will be buying when prices are a little higher. Other months you will be buying when prices dip. Over time, this tends to smooth out and removes the temptation to constantly fiddle with your money based on emotions. Think about two different people again. One tries to time the market perfectly, waiting for the exact right moment to invest a lump sum, checking prices every day, second-guessing every decision. The other simply sets up an automatic transfer once a month and never thinks about it again. Study after study on investor behavior shows the second person almost always ends up ahead, not because they are smarter, but because they remove themselves from the equation. Trying to guess the perfect moment usually leads to hesitation, and hesitation is often the most expensive mistake in investing, because every month you wait is a month your money was not growing. That is the full process. Pick a platform, pick the right account type, fund it, choose diversified investments, and automate your contributions. Simple on paper, but this is genuinely how most long-term wealth gets built. Now let's talk about the question that stops most beginners from ever starting in the first place. What if it all goes wrong? This is the fear that keeps a lot of people sitting on the sidelines. What happens if you invest and then the market crashes right after? Here is some good news. If you followed the steps above and put your money into diversified funds rather than a handful of individual companies, you are already much better protected than most people realize. Spreading your investments across many companies and industries means that even if some businesses struggle or fail completely, the overall basket can still recover and grow over time. Markets have gone through crashes before, recovered, and gone on to reach new highs again and again throughout history. Every single major downturn in modern history, no matter how scary the headlines were at the time, has eventually been followed by a recovery and new record highs. That does not mean every future downturn is guaranteed to bounce back on any specific timeline, but history strongly favors patience over panic for people who stay diversified and keep contributing. It also helps to reframe what a market dip actually means for someone who is still adding money every month. If you are regularly buying into your investments, a temporary dip actually means your money is buying more shares for the same amount of cash. In other words, a downturn is not automatically bad news for someone in the accumulation stage of their journey. It can quietly work in your favor, as long as you do not panic and stop contributing at the worst possible moment. Here is the part that might surprise you. For most everyday investors, the biggest threat to their money is not actually the market itself. It is their own reaction to scary headlines. Picture this scenario. Someone sees a news segment where a confident expert predicts an upcoming crash. Panicked, they sell everything they own. A few months later, that same expert turns out to be completely wrong, and the market climbs right back up. In the best case, that person locked in a small profit before selling and can buy back in later. In the worst case, they sold at a loss, and now they need even more money just to buy back the same investments they used to own. This scenario plays out again and again with everyday investors, and it is one of the biggest reasons regular people underperform the very market they invested in. Not because their fund choice was bad, but because fear made them exit at exactly the wrong moment. And then fear or hesitation kept them from getting back in until prices had already climbed again. The fund did fine. The investor's timing did not. This is exactly why automating your investments matters so much. When your contributions happen automatically every month, you take emotion out of the equation. You are not trying to time the perfect entry point, and you are not making panic decisions based on a scary headline. You just keep going month after month, letting time and consistency do the heavy lifting. So here is the entire plan in one place. Understand that investing simply means putting your money to work instead of letting inflation quietly shrink it. Favor diversified funds over betting everything on one company, no matter how unstoppable that company looks right now. Pick a low-cost, regulated platform, choose the right account type, fund it, and most importantly, automate your contributions so consistency does the work for you. And remember, the biggest risk most people face is not the market itself. It is panicking and abandoning the plan at the worst possible moment. If this video gave you the confidence to finally take that first step, that is exactly what it was made for. Investing does not need to be complicated, and it does not need a huge amount of money to begin. It just needs a plan and the patience to stick with it. None of this requires you to become a finance expert overnight. It does not require watching the news every day or predicting the next big winner. It just requires setting up the system once, letting it run in the background, and giving it time to work the way it has worked for millions of ordinary people before you. The people who end up building real wealth over time are rarely the ones chasing the hottest tip or trying to outsmart the market. They are the ones who started early, stayed diversified, kept adding a little bit every month, and simply refused to panic when things got scary. That is a plan almost anyone can follow, no matter how much or how little you are starting with. If you found this helpful, subscribe for more videos that break down money topics in plain, simple language. See you in the next one.